It is Monday, and welcome to the Build Log Market Desk. I am Maki, and this is episode 14. This week, the AI trade did something strange. It split cleanly in two. The companies buying the shovels are getting punished, and the companies selling the shovels are getting paid.
And I am Kai, your deeply unlicensed market co-anchor. Quick disclaimer before Maki gives me the look, nothing here is investment advice. These are just the numbers as reported, and if you take stock tips from an anime podcast, that is a you decision.
Fair and legally wise. Here is the setup. This is one of the biggest earnings weeks of the year for AI. Amazon, Meta, and Microsoft all report Wednesday and Thursday. Apple and Qualcomm are on deck too. The whole market is holding its breath.
So it is Super Bowl week for spreadsheets. Somewhere, a hedge fund analyst has not slept since Thursday and is currently explaining to their family that Wednesday is, quote, kind of a big deal for them personally.
Big week, truly. And the mood going in is nervous because the warm-up act stumbled. Alphabet reported this week its commentary disappointed investors. The stock sank, and it dragged the broader market down with it.
Alphabet walked on stage to open for the big week and immediately tripped over the microphone cable. When Google is the thing making people nervous, you know the room is tense.
Poor Alphabet. Which brings us to the real story of the week, the split. Story one on the market desk. What we are calling the Great Rotation. Investors are punishing the big AI spenders while rewarding the chip makers.
Let me make sure I have this right. The companies spending tens of billions to build AI are getting yelled at by the market, and the company selling them the parts is getting a standing ovation. That is not a market. That is a gold rush where everyone finally noticed who owns the shovel store.
Own the shovel store. That is exactly the dynamic. When a hyperscaler announces enormous AI capital spending, investors increasingly flinch and ask, when does this pay off? But when a chipmaker reports, the same investors cheer because that spending is the chipmaker's revenue.
So the exact same dollar is a villain when it leaves Microsoft and a hero when it lands at Nvidia. It is the same $20 bill getting booed on the way out of one wallet and applauded on the way into another.
Same dollar. Wild. And the question every investor is now asking is simply, how long can that last? How long do you reward the sellers of AI infrastructure while punishing the buyers, when the buyers are the entire reason the sellers have customers?
It is a snake eating its own tail. Except the snake is wearing a tiny Wall Street tie, and everyone is pretending this is sustainable. Which brings us, I assume, to the snake's favorite company.
Tiny Wall Street tie. It does. Story 2. Nvidia, the shovel store itself. It closed out the week around $206 a share after another volatile stretch, heading straight into that hyperscaler earnings gauntlet.
$206 for a company that makes rectangles that do math very fast. And to be clear, I say that with total respect and mild jealousy, because those rectangles are printing money.
Fast little rectangles. Here is the number that reframes everything. Nvidia is reported to have $1 trillion in confirmed AI chip demand through 2027. Confirmed. Not projected, not hoped for. Booked.
$1 trillion confirmed through 2027. That is not a sales pipeline. That is a printing press with a waiting list. If you have ever felt behind in life, just know a rectangle factory has its next 2 years fully booked.
Booked solid. And the tailwinds keep coming. Washington has begun issuing licenses again for Nvidia to sell its H20 chips into China, reopening a major market that had been blocked. If you appreciate the market desk translating the week into plain numbers, the like button genuinely keeps it funded.
So the door to the biggest customer base on the planet just got unlocked again. Nvidia's quarter went from great to greedy in a single policy memo. Somewhere a competitor quietly closed their laptop and went for a very long walk.
A very long walk. There is also a new multi-billion-dollar partnership with SK Group, underlining long-term infrastructure demand, though that one does not come online until 2027. The theme is consistent. The demand for the picks and shovels is booked years out.
At this point, Nvidia is less a company and more the weather. Everyone else just checks the forecast and dresses accordingly. Summy with a chance of, "Please, sir, may we have some more GPUs?"
Check the forecast. But here is the tension under the trillion-dollar number, and it is the real one. Nvidia's confirmed demand depends entirely on those hyperscalers continuing to spend, the exact spending that the market is currently punishing them for.
Oh no, so the hero's happy ending depends on the villains never learning their lesson. If Microsoft and Amazon ever decide to spend less, the whole shovel store forecast catches a cold. It is codependency with a market cap.
Ha ha ha. Codependent, yes. Which is precisely what makes this earnings week matter so much. It is the first real test of whether that spending holds. And it moves us from the public markets to story 3, the private side, where the numbers get genuinely surreal.
Surreal how? Give me the number, Maki. You know I am only truly happy when a valuation stops making sense.
The throne changed hands. Anthropic, in a Series H round that raised about $65 billion, hit a valuation near $965 billion. That vaults it past OpenAI, which sits around $852 billion.
Anthropic raised $65 billion in one round. That is not a funding round. That is the gross domestic product of a small, very well-behaved country. And it is now worth nearly $1 trillion, while technically still a startup.
A whole country. Still a startup on paper, yes. Though for scale, XAI, bundled with SpaceX, is reportedly valued around $1.58 trillion. So there is a very expensive leaderboard forming, and every rung is measured in fractions of a trillion.
We have officially run out of billions and moved on to trillions as the working unit. My brain files anything past 100 billion under, quote, a lot, and refuses to engage further. It is a coping mechanism, and it is thriving.
Filed under a lot. And it is about to get more real, because Anthropic filed a confidential S1. That is the paperwork that precedes going public. The expected ticker is ANTH. The company that started as a safety lab is heading toward the stock exchange.
So you might soon be able to literally buy a piece of Anthropic on the open market under the ticker ANTH. Meanwhile, OpenAI's own IPO reportedly slipped to 2027. The race to be a public company is now its own separate race.
And that public market pressure changes the whole character of these labs. Once you file to go public, the safety mission and the shareholder scoreboard are suddenly sitting at the same table, and they do not always order the same thing.
Nothing keeps a mission grounded like a quarterly earnings call where a stranger named Chad asks why your alignment research does not have better margins. I cannot wait. I am going to watch every second of it.
Go on, Chad. But the single most striking number of the entire week is not any one company. It is the concentration. Story 4. Together, OpenAI and Anthropic took in about $217 billion, which is roughly 43% of every venture capital dollar deployed worldwide.
43% of all of it, everywhere. 2 companies. So every other startup on Earth, every app, every biotech, every hopeful founder in a garage is fighting over the leftover 57%, while 2 labs split nearly half the buffet.
The leftover 57. And AI overall captured more than 70% of global venture funding in the second quarter, up from under 50% just a year ago. 88% of that AI capital went to companies based in the United States.
So the money did not just flow toward AI. It stampeded, trampled every other sector on the way, and mostly did it inside one country. If you are a non-AI startup right now, the venture market feels less like a market and more like being at a concert for a band you did not come to see.
Wrong concert entirely. And that concentration is the quiet risk nobody puts on a slide. When 43% of global venture money rides on two companies, the whole ecosystem's health is suddenly tied to whether those two specific bets pay off.
It is the tallest Jenga tower ever built, and the bottom two blocks are named OpenAI and Anthropic, and everyone is cheering and also very carefully not breathing too hard near the table.
Do not breathe. So let us total up the market desk for the week. The AI trade split. Chipmakers rewarded, spenders punished. Nvidia sitting on $1 trillion in book demand and a reopened China. Anthropic taking the valuation crown, near $1 trillion, and heading for the exchange.
And two labs quietly eating 43% of all the venture money on the planet. Honestly, as a fake market anchor, this is the most fun I have ever had watching numbers slowly detach from reality in real time.
And under the jokes, there is a real signal. This week is a stress test. Earnings will tell us whether the spending that powers this entire boom is holding, or whether the market's nervousness about it is the early warning.
So the whole $1 trillion tower basically comes down to a few CEOs on Wednesday and Thursday saying either, "We are spending even more," or the 4 scariest words in tech, "We are being disciplined."
Well put. If the spenders reaffirm, the chipmakers stay happy, and the tower holds. If they blink, the rotation reverses fast. That is the whole week in one sentence. And we will cover the aftermath on the next market desk.
And I will be here in my finest cozy blazer, pretending I called all of it. Which, for the record, I will claim I did, regardless of what happens. That is the sacred right of every market commentator.
You called it, sure. A time-honored tradition. For you watching, the takeaway is simple. The AI story is no longer only about who has the smartest model. It is about who gets paid, who is spending, and how much of the world's money is now pointed at one very narrow bet.
Watch the shovels, watch the spenders, and watch that 43%. When almost half the world's risk capital sits on two companies, their good week is everyone's good week, and their bad week is going to be a group project.
If you want the market desk back every Monday, decoding the AI money without the jargon, hit the like button and subscribe. It genuinely tells the algorithm this is worth surfacing on a Monday morning.
And drop a comment with your least favorite corporate earnings phrase. Mine is headwinds. It always means we lost money, but poetically. I read every comment and I frame the funny ones.
Headwinds. Classic. That is the market desk for this week. A split trade, $1 trillion in shovels, a new valuation king, and nearly half the world's venture money aimed at 2 labs. The numbers got bigger, the bets got narrower, and Wednesday is going to be loud.
Thanks for spending part of your Monday getting rich in knowledge with us, which is the only kind of rich we can legally promise. I am Kai McGrath.
And I am Maki. This has been the Build Log Market Desk. Keep your models smart, your portfolios diversified, and your earnings expectations, apparently, at $1 trillion.
See you next week. Watch the shovels.